Hi, good morning. My name is Jim Rapon with Coldwell Banker Danforth, and this is Seattle Real Estate Chat. And I'm here this morning with Rhonda Porter. Rhonda, would you like to introduce yourself?
Thanks, Jim. I'm Rhonda Porter. I'm a licensed loan officer at Mortgage Master Service Corporation. I'm also author of the blog, The Mortgage Porter.
And Seattle Real Estate Chat is a Google Hangout that we do every few weeks. Rhonda and I do to keep people abreast of things that are going on in the real estate market here in Seattle. Try to give current news, issues, and market conditions, as well as just things that we think you might be interested in relating to real estate and somewhat local in the Seattle area, if possible. So today we're kind of going to straddle a couple things here. We're going to talk a little bit about investment properties in Seattle and how that market has kind of changed recently. And we're also going to talk about new conforming loan amounts and how that has also changed to the better. And then Ron is also going to talk about some investment loan programs that you might not be aware of. Owner and I believe non-owner occupy as well. Is that right, Rhonda?
That's right.
Okay, good. So let's start off with the investment world these days. It has changed fairly dramatically as prices have risen. We're now almost at the 2007 peak market level. Not in every neighborhood in every area, but in some it's surpassed that. So it's no more bargain basement prices or anything, but there's also a whole lot more people who are doing some savvy calculations about where the market's going and where the opportunities are. And what I found, and I think it's pretty easy to find if you keep up of the news, you read the newspapers or the blogs or some of the internet sites, that there is a whole lot of foreign money now coming into the Seattle area. And press is a lot around the money that's coming in from China, and that's significant. It's not, it is probably the most significant. We're seeing about 30% of the sales over 1 million being purchased by foreign money, mostly Chinese, on the east side. Anything over 1 million is 30 to 50% of them are cash transactions and mostly Chinese. So that's huge. But it's also huge in the other markets too when you're looking at commercial and retail and that kind of real estate. And that is not as much a Chinese market as it is some of our traditional foreign investors. Dutch, a huge amount of Canadian money, German money, and all of them see Seattle as a very strong forward market in real estate. So if you a good example of that would be the net absorption rates of offices. It has gone down significantly, and that just means how much supply there is in a 90-day period of office space. If someone wanted to come in and rent 100,000 square feet of space, how long would it be before all of that was gone? And that's an absorption rate. Anyway, Seattle is ranked #1 for that, and it has become one of those destination cities where you see a ton of people thinking, if I want to kind of come to a foreign country and settle down, this is the kind of place I'd want to be. Have you seen this in loan situations like I have seen it in cash situations, Rhonda?
Not as much, I think. Well, I mean, partly because it sounds like they might be more of a cash buyer type situation. So I do have some because we do a lot of loans for high tech borrowers, and so you will work with borrowers from other countries then too. But it's I don't think it's nearly as what you're seeing.
Yeah, it is hugely significant. There was even an article in the New York Times about it, I believe, about Seattle's real estate market with foreign money. One interesting statistic in that New York Times article that I thought was quite significant was that they did a survey, a poll in China, and it was a pretty significant poll. It was in the thousands, not hundreds, that they did this, and it turns out that 69% or 64% of Chinese over 50 plan to expatriate when they retire, plan to move abroad and live abroad.
Wow.
and that's huge. I mean, I don't know what the U.S. rate, but I bet it's about 4 or 5%. People say, well, yeah, I'll move to Honduras or Thailand or Brazil. Maybe you get some people wanting to move to France and stuff, but the vast majority of us stay where we were, and so that's huge. But there are factors: the overcrowding, the pollution, the trust in the system, and then coming to a place like the U.S. where it's very diverse, and typically they're not. You can get away with not having to learn the second language for them being English. They could get away with staying in a Chinese mode and find communities that fit their lifestyle and fit their background fairly easily. So as of 2013, their Chinese money. We'll just talk about Chinese money right now because that's one of the biggest growing cash pots. There was, I wrote this down, $659 billion worth of real estate investment in the United States from Chinese in 2013. That's expected to grow by 2018, which is 2014 now, so just 4 more years, to go from 659 billion to 1.9 trillion. And that's just in real estate investment. So we are not at the peak even of this surge, and so that creates opportunity. So let me just dial this down real quick for, okay, well, how does that relate to me if I'm just an investor who lives here locally and maybe has 100,000 or 200,000, and I want to try to figure a way to do this in terms of a safe real estate investment. Start thinking in terms of what this market that is going to be coming here are going to want, and so the things that you commonly find for investors looking for are stability. They're looking for stable schools with really good school atmospheres. They're looking for great shopping. They're really concerned about crime. Crime is like right up there. It's education and crime. They want a very low crime rate. They want a very good education system. So if you're buying residential homes for real estate investment, and Seattle's ranked one of the #1s for doing that, buying and holding. If you think about the type of people who are going to want to buy it when you get to the time when you do want to sell it, be that 10 or 20 years from now or whenever, think about what kind of people, what kind of market would be the most desirable at that time. So I think that can give you some insights. Some of that's pretty easy to see in trends if you start looking at demographics and where sales are happening and how tight certain markets are. But that, I think, creates some opportunity. So that's just my 2 cents. Throw it in there as a tip for what it's worth. You have anything you want to add about the investment market these days, Rhonda?
Beyond talking about the programs, or?
Well, just investment in general. I mean, I know both of us follow what's going on in the market and how investment is kind of been taken off here, but I just wondered if anything from the mortgage perspective you wanted to say, other than maybe you do want to just talk about the programs that.
Well, I mean, I am seeing a pickup in investment buyers right now. People are wanting to get into the market, and when we have had some changes with that lately, one of them, a tool that a lot of first-time investors would use would be the Fannie Mae Home Path mortgage, which was a 10% down program, and Fannie Mae did away with that mortgage. Last month. So that's no longer an option for an easy way into the market to buy a home. So they still have what they call Fannie Mae Home Path homes, and they have, which is their foreclosed homes that they have, but they offer different incentives instead of offering the mortgage with lower down payment options. So one thing that I wanted to touch on with that going away is that typically what buyers have had to do for investment mortgages have had to be put like at least 20% down, and so that's kind of like the Home Path was such a nice easy way in, and so but now we also have a 15% down program too, and so we can go over that whenever you're ready to do that too, Jim.
Sure. Just a couple quick questions before we jump into that. I get a fair number of clients who say, well, I'm not a citizen here, or I don't have a green card here, or this wouldn't be my primary residence. I'm still going to live in Canada or China or Taiwan or whatever. Will these programs we're going to talk about, would they work in those kind of situations if you can verify income, even though it's foreign income, or not?
Oh boy, it's going to, that's really tricky. they, and I'm not really sure. I would
Okay.
have to, yeah, I'm not really sure on that one.
I'm guessing
Um,
that the green card's probably the no problem one if there is one,
right,
if they've got a
right.
green card. But a number of people come over here for a period of time, and they maybe have family over here and they want to invest, but they're really not planning to be here for another 10 or 20 years, uh,
Right.
or they just want to hold on to it for an investment. Period. So just curious about that. We see that more and more. The other thing I wanted to touch on before you jump into these programs is that this trend that I'm talking about investments from foreign countries is probably going to, another thing that may really accelerate this. I don't know if people paid attention to this, but President Obama just set up a visa extension program as part of his China trip. It was mostly around trade, but if you look close, one of the things that they talked about is increasing visas from 5 to 10 years for tourists and for business and education and exchange. So that's going to open the door for people feeling a lot more comfortable about, hey, I can get a visa for 10 years, so I can come and go as I please, versus a shorter time where they got to renew it and stuff. So again, just think that may put some acceleration on an already growing market. Anyway, so would you like me to put your stuff on screen here?
Sure.
Okay,
Sure. I
so
just have a
go
couple
ahead.
examples. Yeah, go ahead. That would be great.
Okay, let's see here. I think this one's the 20-year one.
20% down. Yes.
20% down,
And
I'm
so
sorry.
that's okay. And so I'm using a sales price of 400,000, and because of our regulations, whenever I'm talking about down payment, I have to quote APR2 because it's considered a loan term, so I can't talk about just vanilla terms. So I picked a sales price of 400,000, and I don't know, Jim, can you even find an investment property in Seattle for 400,000, single-family dwelling, or?
Sure, although another statistic was that the median price is much higher for a foreign buyer. It's 580 versus 400 something for investors here locally.
Yeah.
But
Yeah.
at any rate, anyway,
Yeah.
let's work with this.
So just to give for comparison's sake, 20% down conventional is just kind of like the vanilla uh, program for buying a home, and I'm just using a 30-year fix because again, I just really wanted to focus on down payment more than doing ARMs and whatnot too. But so for 20% down on a $400,000 home, a investor would need to come up with just almost $90,000 depending on how they have the loan priced. And this at 4.5% today, which has an APR of 4.628%, has a just a slight discount on there. It was just over a half point. So so that's what a investor would need to do if they're buying a single-family dwelling using a conventional mortgage. So what is kind of I thought kind of exciting or a nice new option to have though too is that mortgage companies are now offering to do mortgage insurance on investment properties, and so you can do less than 20% down. And if Jim, do you want to jump to the other screen for me? Look at that, snap, just like that.
Just like that.
Yeah, and so the rate is slightly higher by an eighth with this program, and there is mortgage insurance, so you got to factor that into your profits or into your rent. But it allows you to come in with slightly lower down payment with 15% down, so you can save that 5% for either improvements or maybe the person doesn't have the 5% for that. So with this scenario, instead of coming in with almost $90,000 on a $400,000 home, they can come up with $70,000. So it kind of like opens the door up more for investors. So so I just thought that was kind of an interesting option. It does raise the payment compared to the other scenario that we have by, let's see here, by almost $300 a month, and that is because of that mortgage insurance and the rate being about an eighth higher. And again, I priced this one out about the same as the last one too, just so we can compare apples and apples.
Okay. And another quick question here. When we're doing these things, are you basing this on personal income or income of just the property, or both? I mean, are we looking, do we need a certain cap rate? Do we need a certain net return, loan to value, or I should say income to loan to make it work, or how's that work?
Yeah. Well, debt to income ratio is very important, but the one thing that's kind of nice is that Fannie Mae recently revamped their underwriting guidelines for investment properties. And I actually just wrote a post about that this week on my blog. So what it used to be harder to use rental income, especially for a new investor, but you just need to, if you're buying a home, if you have a signed lease agreement, that can be used if the tenants are staying in there for rental income. It's going to be discounted, if the income's not already on your tax returns, and if you're buying a home, it's not, obviously. So that rental income will be discounted by 75% is what we do. That 25% is taken out because the lenders are factoring in the cost of having a rental, basically.
Okay. So you get to keep 75% of it. 25% is discounted. Okay, I got it.
The other thing that's used too is when you get your appraisal with the rental property too, and that appraisal is a little bit more expensive than a regular appraisal than if you were getting like for an owner-occupied primary residence. But the appraisal is also going to have information on what market rents are for the area too, which will help support what that value is being used for the rental income as well.
Another question I'm gonna throw at you. I don't know if you'll have the answer for it, but I do run into this. Is we get these properties for a 10-plex properties investors are looking to purchase, and they have been at really low rents. I mean, they have not cut up the market because the market has grown substantially, and if landlords had not been aggressive about that, their rentals are real low, and you can really look at the comparables and see they're down like 30% of what the market is. So, they're typically going to raise the rent. Sometimes I even evict people, clean them up, and raise them even higher, whatever. If someone realizes that means that income is probably not really going to help them that much in the purchase process, and they have a net worth where that's not going to be a significant drag anyway, how long would they need to wait before going, okay, now I want to finance it because I want to use these rents to justify how much of a loan I want to get? Do they need to have those rents be stabilized for 2 years or just a year? Or do you know the answer to that?
Well, I'll answer that as good as I can. For one thing, we would be limited to a fourplex. Anything beyond a fourplex would be commercial. So for based on a fourplex, for example, and I'll confirm this with our underwriters afterwards, but I believe we would just need signed lease agreements from the new tenants. And then we may also want to see that the deposits, if it's a brand new lease, and so that we know that, like the security deposit, proof of deposit, and stuff, and that it was actually deposited into that account. And the reason for that is to make sure that the investor isn't just making up lease agreements to support a higher rent amount. So that's something that can happen too. And one thing too, another way that a person can get into the rental market is if they're converting their existing home into a rental and then buying a new owner-occupied home.
Right.
And with that case too, depending on how much equity they have in their existing home, it would be the same thing where as long as they actually have a renter for it before closing and they have the signed lease agreement and a copy of the check for the security deposit and proof that it's cleared their account, that rental income, 75% of that rental income can be used to offset their old mortgage payment.
Okay, that's great. Now, this is segueing right into what I wanted to talk about at a future Seattle Real Estate Chat episode, and I mentioned we were talking about it earlier this morning, is talking about these 203K FHA rehab loans, which would be ideal for a fourplex that had stuff that needed to be fixed up in order for you then to get higher rents and a better mortgage on it as well. So for another day, we're already out of time. There's a lot of detail to that one, and it's a whole other topic, but it does segue well from this one. So I think we're going to have to, we're already at 20 minutes. This just runs by. I hope this has been helpful for people, both in looking at loan programs that would be an option, as well as market conditions for investors and some of the opportunities out there for people. And feel free to email us or tweet us at, if you just hashtag Seattle RE Chat, we'll see your tweets that way. And I'm at Jim Rapond on Twitter. Rhonda, what is your Twitter handle?
I'm at Mortgage Porter.
At Mortgage Porter, okay. And go ahead and shout out your website again, your blog.
It's mortgageporter.com.
Okay, and my website, seattle-realestate.com. So thanks again today for watching, and if we can help you in any way, either in real estate brokerage or in mortgage acquisition, please let us know. Thanks so much, and have a great day. Bye.
Thank you. Happy Thanksgiving.
Happy Thanksgiving, everybody. Bye.
Okay. Bye bye.